Hello, everyone. I am Dr. Duru from Ahan Analytics with the market breadth. First of all, to those of you in the half of the US that is snowed over and iced over, please hang in there, stay safe, okay? All right. Now, the market view I have is probably aligned with the risk from weather. I'm risk off in the coming week, and it's not because of one single headline or just a gut feeling. It's because market breadth failed twice at the overbought level. One failure is enough to make me cautious, but two tells me that the market is fighting too hard just to go higher. Now, on top of that, we're in earnings season, and for short-term traders, earnings season is usually a time to manage risk, not press it. So for me, this is a week for more watching and studying, not aggressive buying. And of course, for you long-term holders, it's just a time to sit back and hold and look for the dips to buy. I mean, that's always going to be your mantra, right? Well, importantly, this kind of environment tends to favor bears. When breadth is weak, rallies like the one we're starting to see build up in software become opportunities to fade, not chase. And again, I'm only talking to the bears there. If you're bullish and you want to buy software stocks, you know I'm bullish, I'm contrarian bullish on the software stock. So I am looking for spots to buy. I bought and sold some this week, but I'm going to hold some through whatever's to come. Anyway, let me show you exactly what I'm seeing in market breadth, why the second failure matters, and how I'm thinking about risk from here. All right, let's take a look. All right, as I always like to do, I start with market breadth. This is the percentage of stocks trading above their 50-day moving averages, what I like to call AT50 for above the 50. All right, now here are the two failures. And, I had to do some little animation to make this more dramatic. Here's the first one. So remember, AT50 rules state that a fade from the overbought level, which is 70%, is bearish. If AT50 drops out of oversold condition, so it spends some time above the overbought threshold and then drops down, that is bearish. This was a revision that I made years ago because earlier in the days, particularly before the Fed was so interventionist in the financial markets, it actually was enough just to get bearish as soon as AT50 hit the overbought threshold. But now, with so much stimulus that is used to keep the markets propped up these days, really need some higher bar. I really had to put in some higher bar criteria. So that's what the criteria is now. And unfortunately, AT50 hit the criteria twice this week. So on Friday, there was this initial fade. So this is what I talked about last week. And then we started this week with a major confirmation. This was a holiday shortened week. So this is a Tuesday. And AT50 fell all the way, closed at 62%. And then we had a rally, and then looked like, oh, we are going to bust into the overbought threshold and then flip back bullish again, or, bullish like. But instead, AT50 faded intraday, closed below the 70% threshold, and then sellers confirmed once again a bearish move. And so we closed the week at 66.3%. AT50 is thus, in the last week, created two bearish signals, confirmed both of them actually with follow-through selling. This is why I'm short-term bearish on the market. Now, mind you, like I always like to say, this is not a sell all, sell everything, hey, things are going to crash and collapse kind of bearishness, okay? It's just short-term. It means that I think I am biased for weaker prices over stronger ones. Lots of stuff can happen. This is earnings week, and earnings week is what makes me even more cautious because with this double failure at the 70% threshold, I'm assuming that risk is heightened, that people who are more short-term in nature are going to be more prone to sell than they are to buy the news. And we've had a lot of news, of course, that the market has survived. Great, like this Greenland, the escalation with this Greenland tensions. things have pulled back, but at any time things can unravel again. And what I'm really surprised about is that the market hasn't cared a lot about the blow up in the Japanese bond market. But that's a topic for another day. Let's stick with these technicals. So that's AT50, the percentage of stocks trading above their 50-day moving averages. Now, I also like to do a quick check-in on the longer term indicator of market breadth, which is the percentage of stocks trading above their 200-day moving averages, what I like to call, of course, AT200. You can see here that it's mapping the same pattern as AT50, but if I pull back, you could see it's still generally high. It's higher than it was for most of last year. In fact, I think it's still higher than it was, for all of last year. So longer term, things still seem pretty good, and there's an uptrend that's still in place. So that's fantastic, because if we look at the indices like the S&P 500, and we'll wait a second for it to come up here. The S&P 500, of course, it's overall in this uptrend. We can see that very clearly. But in short term, this is what got me all excited earlier this week, this breakdown below the 50-day moving average. I was expecting that, look, we have been fortunate that the S&P 500 has tested this important support line. It's the red line 3 times, and this was a 4th. And it looked like, okay, buyers are finally going to get tired of this repeated pattern. I mean, look, it's been really consistent, right? But sure enough, buyers stepped right in. And as I joked, slightly tongue-in-cheek in a short that I did on this, or a short video I did on this, it kind of seems like policymakers are keeping an eye on the technicals of the market now. Because when drama breaks out, suddenly something steps in, good news or whatever. And this time the good news was a complete reversal on the Greenland escalation that happened the day before. The S&P 500 responded, jumped 1.2%. But look at this. The follow-through stopped cold at 20-day moving average resistance. That's this dashed line. So this helps me to stay risk off, because the S&P 500 really, it's great. It recovered from this 50-day moving average breakdown, but it's still telling me that it's not going to break above this all-time high anytime soon. So that's the risk-off posture that I have. The NASDAQ is even more, makes me even more wary. And that's because it created its breakdown, and on the next day, it didn't even recover the 50-day moving average. It took a second day of buying. And on top of that, this breakdown has happened without the NASDAQ ever re-challenging or making a new all-time high, unlike the S&P 500. So now the tech stocks are basically trading under this really big looming cloud, this kind of overhang, which is it has yet to challenge or get above the last all-time high back in October. And the bearishness could just play out in rallies that get faded. It doesn't have to mean, like I said, a crash or a collapse or, 4-alarm fire kind of thing at all. It just means that chasing rallies is not going to be, I am not expecting rallies to be fruitful. And that's totally what I'm avoiding here. Now, my favorite, as you all know, the ETF of small caps, IWM, the iShares Russell 2000 ETF, it has been on a tear this year. And of course, I've enjoyed it because I have a large core position in IWM. And of course, I trade around it. I finally opened up a trade around my core position starting on Thursday and Friday. And, it may be late. I'm really, I can't believe I didn't really play the call options earlier this year, but it is what it is. I'm not going to complain about IWM rallying when I have such a large core position. Anyway, you could see the outperformance, the relative outperformance for IWM, new all-time high on Thursday, but it pulled back 1.9% here on Friday. And that is what pulled the market breadth down. In fact, that's what happened earlier this week too, in terms of the follow through. IWM didn't create the first bearish breakdown for market breadth, but it did help create this second one. So if we're getting the synchronicity between small caps and other stocks in terms of confirming bearishness for market breadth, that makes me wary. That makes me risk off. Okay, hopefully you get that from the AT50 to AT200 to all the indices. You get the general context of now what I'm going to show you very quickly are the individual stock charts that tell the narrative for me in terms of my attitude and orientation towards the market. First, let's start with gold. It has been on a tear even more than IWM. I think, well, I forgot I haven't calculated the percentages, but look at this. GLD, which is the Spider Gold Shares ETF, opened the year, let's just call it around 400, and now it closed at 460. I mean, that's what is that, you math wizards out there? That's what, about a 13, 14, 15% gain already this year. And that's amazing. But now gold GLD is starting to get parabolic. It's got multiple closes above the upper Bollinger Band, which is this black line, and it started to stretch. On Thursday, it started to stretch even further. And look at this, on Friday, it gapped above the upper Bollinger Band. So this is just, it's great in terms of bullishness, very short-term bullishness, because buyers are pressing. But eventually buyers wear out, they get exhausted. And because it's a parabolic move, usually the pullback's pretty sharp. So that's what I'm watching for. I locked in my profits on my last GLD call option spread. Again, that's part of my risk off. I know you would think that you want to buy gold when you're risk off, but I'm talking about all assets when I say risk off. So now I'm stepping back and I'm going to wait for the next pullback on GLD because I'm still overall bullish. Pull back to the 20-day moving average or the 50-day moving average. Now, for my commodity plays that are kind of run in parallel to the precious metals, I'm not selling a thing. I'm just writing these things out because I think the economy is being run hot. It's going to be run hot, and governments, central banks, despite their any anti-inflation rhetoric they have, they're going to be more cautious about any economic weakness. So that's my bet. And we know there's a lot of investment going into infrastructure for AI, infrastructure for energy, and so on. All of these things are going to just suck up commodities. So I am in Rio Tinto, and this actually worked out very well because Australia, where Rio Tinto has a lot of its operations in terms of iron ore, Australia has had some strong economic data. So anything Australian is bullish. And so I'm glad I got into Rio a lot earlier, months ago, with the narrative and the theme that I just talked about. Now, another surprising thing. Now, the U.S. has been in the middle of a firestorm, of course, causing a lot of places in the world to get antsy, angry, whatever you want to call it. And I was surprised to see that the ETF for Mexico, ticker symbol EWW, the iShares MSCI Mexico ETF, it's had a great year. It opened the year around 70, a little less than 70, and now it's at 76. It's almost gained 10% just this year. And if I peel back, Mexico has been having a great rally since, let's just call it spring of last year. This amazed me. I really took my eye off the ball on Mexico, even though I've traded the peso successfully. I don't know why I didn't think in parallel to jump into EWW and just sit in it. But it is what it is. Mexico has been bullish. Now, remember when I talked about it's hard to be bearish on the market when financials are acting bullish? Well, right after I said that, of course, the financials fell out of bed. Last week was a big week, or the previous week was a big week for financials. XLF, ticker symbol XLF, the ETF for the financials, fell out of bed in the previous week, dropped right to the former all-time high, barely paused at 50-day moving average support. And then this week, it opened this week, financials had followed through weakness, 50-day moving average breakdown. Sorry, that's the 50-day moving average breakdown. Another weak rally, failed right at 50-day moving average resistance, and now sellers came in with a force on Friday with a 1.4% drop back down now to, let's just say, the beginning of December. So financials are bearish. They help to drag down or help to create that breakdown from market breadth. This is, again, while I'm risk off, because now financials have gone from confirming bullishness very quickly to creating bearish risk off conditions. So I am going to keep an eye on XLF. It's probably going to test, at this rate, it's going to test its 200-day moving average, which is that blue line. So that's what I have my eye on. Now, I talked about software stocks earlier. I won't go into all of the plays that I made this week. I'm going to focus in on the one that I bought and I'm going to hold. And the reason why I'm going to hold it is because ServiceNow has done some great AI acquisitions. They have inked a deal with OpenAI. I think they have their eye clearly on the ball. They see where the puck is going, as the saying goes, and they are ready. I don't know why people have been panicking and selling ServiceNow as if it's going to go out of business in a few years. This is a great opportunity. I bought some earlier this week as a part of my contrarian call on software stocks. I did a video I've written on my blog, drdewar.com/122, about this. So I won't go into all the details, but I just wanted to show the one stock, the main software stock that I bought this week that I'm holding on to. There were several others that I traded in and out of. One is Wix, which is the web publishing platform. This is Wix.com, ticker symbol WIX. And this was like a perfect bottom fishing play. So for you short-term traders, listen up. Here's the setup. Wix selling off day after day after day. So you saw how there were stocks that have been soaring all year long. Software stocks like Wix.com have been selling off every single day to start the year. Look at this volume, building, 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 building. You know what that means? A crescendo. Just like I was talking about, parabolic moves don't last because buyers soon get exhausted. Same thing applies to selling. This is essentially parabolic selling. Look at how the bars are getting longer and longer and longer. People are panicked. The panic is growing. The fear is growing. But fear and panic only last so long in the market, even for individual stocks that may have bad theses, a bad thesis or narrative behind them. It only lasts so long. And here was the classic signal. This is called in technicals a morning star, because there's a gap down, a doji. Let me zoom in here. A doji that shows intraday stalemate between buyers and sellers, and then a confirmation of a bottom the next day when Wix gapped up and then gained 4.6% on the day. That's where I got a call spread, and I went ahead and took profits at the end of this week. So actually with the call spread, I wasn't even as aggressive as I could have been and should have been on this kind of clear bottoming play. So I really wanted to hone in on this one, even though I'm already out of the trade and I'm not looking to buy back into Wix anytime soon unless another golden setup shows up like this. I just wanted to use this as sort of a trade school, as an example of how I'm looking at the software plays. Some of them are short term, and some of them very short term. Others, like ServiceNow, are for longer term. All right, let's go. Let's keep it moving to Lululemon. I'm only showing this one because this looked like a turnaround stock. You can see Lululemon has been in the dumps for quite some time. It peaked in, I think, 2021. It churned a lot for several years and then started selling off again, but it looked like it was bottoming. Since a big post-earnings collapse last September, it looked like it was bottoming. Unfortunately, it ran right into resistance. It had a good earnings report last month. It soared 9.6%. It kept rallying, but look at this, perfect. This is why technicals matter. Look at how Lululemon gapped higher and then crapped down. We call this a gap and crap, right below that 200-day moving average resistance, that blue line. And Lululemon, ticker symbol LULU, has not been the same since. Sellers have been weighing on the stock all the way to the 50-day moving average, even punched through it. And now Lululemon has gone from a bearish to bullish reversal. It's now bearish again. And part of it this week, I think, or the last week, was that they had some bad news on a big glitch, I'll just say, with one of their clothing lines. All right, Reddit is a stock I tried to play from the long side. I got a call spread, ticker symbol RDDT. This didn't work out. I was hoping Reddit would hold the line here at 50-day moving average support. This was before, of course, I got risk off on the market, and I was thinking Reddit was poised to just bounce right back. It did not. But sellers didn't follow through on this big breakdown. It broke down, 6.8% below its 50-day moving average, and then buyers stepped right in. So I'm holding on to see whether Reddit can fight through this bearishness and get above its 50-day moving average again and give one last pop. Overall, Reddit is not, it's kind of neutral because it's really been churning in a trading range ever since last summer. So I don't have an overall call on the stock, but just this very short-term play that I tried to do is on the ropes, essentially. Apple has been Now, everyone's been talking about the weakness of Mag 7. So how small caps money has left tech stocks, it seems, and gone to small caps. Gold, commodities, and I think consumer staples have all been soaring all year. Apple and other big tech companies, except for I think Google, have been selling off for most of this year. And Apple in particular, look how weak it's been. It broke down to, below its 50-day moving average. Let's zoom in at the end of last year and confirmed the breakdown to start the year. And sellers just took off from there. Notice the accelerated selling down here. It finally hit a culmination point and the buyer stepped in, but look at how weak the buying was, very tepid. Could not even reverse the last selling candle, and that was a signal to bears to jump all over Apple again, and swoosh, look at this. Just sellers swarmed on Apple. And now, even though I think this is another attempt to bottom, you could see these long tails from intraday lows. Unfortunately, Apple's probably going to risk a test of 200-day moving average support unless its earnings in the coming week can really wow investors or calm whatever nerves are happening about Apple, ticker symbol AAPL. Netflix is one that I have my eye on where I want to be contrarian. There's been a lot of negativity all of a sudden with Netflix because of, mostly I think because of the deal that they're pursuing with Warner Brothers and the fight that they're having with Paramount. And you can see that Netflix last peaked last summer, and it's been pretty weak ever since. And this bid for Warner Brothers has really taken the stock down a lot more, to the point now that Netflix closed this week at $86.12. It did pop for the day 3.1%, but overall you can see that it's testing its lows from the April trauma, drama, and noise. I think this is a spot to buy. I did play earnings with a calendar call spread, didn't work out. And now I'm looking to start buying shares because I think, let's see if you can see this here, Netflix is putting on a bottoming pattern. I previously wanted to wait until it got above 89, but I don't think I need to because I can see the buyers are now starting to get interested in Netflix at these levels. And of course, having the support at the April trauma, drama, and noise helps. So even if Netflix were to continue selling off from here, I think it's at great levels for a long-term hold. That's my perspective here. So this is not a short-term trade for me. This is an investment. I'm like other stocks that I've talked about in this same situation. What I'm expecting is to be able to look back in several years and be grateful or thankful that I went ahead and started buying Netflix around these levels. Now, Intel, as some of you know who follow my work, was on my shopping list for 2026. This has been an outstanding trade. It was so good that I decided to hold on through earnings, and I did not get rewarded for my patience and the risk. So this is another reason why I want to be risk off, because I got burned trying to be risk on going into Intel's earnings. I know Intel was a little stretched. It was rallying all year, trying to keep up with the semiconductor stocks that have also been very hot. Fortunately, I had the opportunity to sell 2 call options in the middle of this rally. The last one was right ahead of earnings. So about half of the gains that I had in my shares are now gone. I'm going to just go ahead and hold on and see whether Intel can at least hold the line at 20-day moving average support and just see if at least the stock can just stay stable and allow me to just sell call options against it. I know earnings earnings was a big blow up, 17% drops. That's never fun, but I was just fortunate to be able to have some buffer because I bought early enough in the year because Intel, like I said, was on my shopping list. So that's ticker symbol INTC, and it's going to stay on my shopping list. As some of you may know who read my blog, I had this thing that I call the between earnings trade. So now my antenna is up for buying call options between Intel's earnings reports. And when I buy those, I'm only buying those at natural support levels. So the 20-day moving average is coming up. The 50-day moving average is next. Hopefully, Intel's not going all the way back down to the 200-day moving average. That would be a pretty big drop and would basically reverse a lot of the goodness that's happened recently. All right, last stock. I've revisited this one a few times. This is Booz Allen Hamilton Consulting Company, ticker symbol BAH. It's unfortunately a stock that that got called away from me because I sold a call option. I've done it twice now on this stock. I've actually had several successful trades. So watching it soar today, on Friday, 6.8%. Post earnings a little disappointing, but I think it would have been hard for me to justify holding onto the shares in this precarious position under downtrending 200-day moving average support. Let me just pull back for you to just let you know how bad Booz Allen Hamilton, ticker symbol BAH, has been trading since late 2024. So this is not a stock to take a risk on. The only reason why it's even on my radar is that, this is not a stock to take big risks on because of what I just showed you. But the only reason why it's on my radar is that right here, the CEO really loaded up on shares way back in October after the previous earnings report. And you can see how bearish traders and investors are in the stock because they held their ground for a few days after this announcement, but then the sellers picked right back up and took BAH to multi-year lows. So this was a big risk on my part back when I was buying and then selling calls against it and holding the shares. So I felt like I didn't want to press my luck, and that's why I went into earnings without shares. But check this out. Again, for you technical folks, even though this was another gap and crap example, see, it gapped higher and then sold off and closed lower into the day, lower than the high of the day, it did hold 200-day moving average support. So if it can start to move higher from here, this is a signal, particularly for short-term traders, that this stock is a buy. And I think if it can confirm holding the support, this could actually confirm a bottom for this stock finally. And in that case, then I would come back in and just be a long-term holder. I'd have no idea how much higher this could go. It could get all the way back to its all-time highs in due time, months or years. Anyway, I hope you enjoyed this. I really took my time on fewer stocks because there were a lot of great stories here. Hopefully all of this, the whole risk off meme makes sense in the larger context of risk now, but opportunity for later. This is Dr. Duru from AHA Analytics with the Market Breadth. Please like and share this content so the algorithm knows it's up. If you have any questions or comments, of course, put them down below. Please subscribe to the channel. Put on the notifications so you get notified when I have content. I do one of these a week, and I try to post a few shorts in the middle of the week on just very quick commentary about very important things that I see between the bookends of my longer form video. All right, thanks for checking this out. And as always, be safe out there. And like I said, for those of you who are suffering under the weather, I appreciate that you even made it this far in the video, but please stay safe and take care and stay warm. Bye-bye.